We will now shift over to the analysts and Johnny Brent.
Hi, Warren. Hi, Charlie. Thanks for having me. You've addressed the risk of driverless cars to Geico's business, but it strikes me that driverless trucks could narrow the cost advantage of railroads even if the number of crew members in a locomotive eventually declines from 2 to 0. Is autonomous technology more of an opportunity or more of a threat for the Burlington Northern?
Oh, I would say that driverless trucks are a lot more of a threat than an opportunity to the Burlington Northern. And I would say that if driverless cars became pervasive, it would only be because they were safer, and that would mean that the overall economic cost of auto-related losses had gone down, and that would drive down the premium income of Geico. So I would say both of those, and autonomous vehicles, widespread, would hurt us if they spread to trucks, and they would hurt our auto insurance business. I think my personal view is that they will certainly come. I think they may be a long way off, but that will depend. It'll probably, frankly, depend on experience in the first early months of the introduction than test situations. And if they make the world safer, it's going to be a very good thing, but it won't be a good thing for auto insurers. And similarly, if they learn how to move trucks more safely, tends to be driver shortages in the truck business now. It obviously improves their position vis-a-vis the railroads. Charlie?
Well, I think that's perfectly clear.
Yeah. Finally, approval all these years. Okay. Station 1, the shareholder.
Hi, Warren and Charlie. My name is Brian Martin, and I'm from Springfield, Illinois. In the HBO documentary, Becoming Warren Buffett, you had a great analogy comparing investing to hitting a baseball and knowing your sweet spot. Ted Williams knew his sweet spot was a pitch right down the middle. When both of you look at potential investments, what attributes make a company a pitch in your sweet spot that you'll take a swing at and invest in?
Well, I'm not sure I can define it in exactly the terms you would like, but we sort of know it when we see it, and it would tend to be a business that, for one reason or another, we can look out 5 or 10 or 20 years and decide that the competitive advantage that it had at the present would last over that period, and it would have a trusted manager that would not only fit into the Berkshire culture, but that was eager to join the Berkshire culture. And then it would be a matter of price. But the main, when we buy a business, essentially we're laying out a lot of money now based on what we think that business will deliver over time. And the higher the certainty with which we make that prediction, the better we feel about it. You can go back to the first, wasn't the first outstanding business we bought, but it was kind of a watershed event, which was a relatively small company, See's Candy. And the question when we looked at See's Candy in 1972 was, would people still want to be both eating and giving away that candy in preference to other candies? And it wouldn't be a question of people buying candy for the low bid. And we had a manager we liked very much, and we bought a business that was paid $25 million for it net of cash, and it was earning about $4 million pre-tax then, and we must be getting close to $2 billion or something like that pre-tax that we've taken out of it. But it was only because we felt that people would not be buying necessarily a lower price candy. I mean, it does not work very well if you go to your wife or your girlfriend on Valentine's Day. I hope they're the same person. and say, here's a box of candy, honey. I took the low bid. It doesn't. It loses a little as you go through that speech. And we made a judgment about See's Candy that it would be special, and probably not in the year 2017, but we certainly thought it would be special in 1982 and 1992, and fortunately we were right on it. And we're looking for more See's Candies, only a lot bigger. Charlie?
Yeah, but it's also true that we were young and ignorant then. And
Now we're old and ignorant. Yeah.
yes, that's true too. And the truth of the matter is that it would have been very wise to buy See's Candy at a slightly higher price. And if they'd asked it, we wouldn't have done it. So we've gotten a lot of credit for being smarter than we were.
Yeah, and to be more accurate,
Yeah.
if it had been 5 million more, I wouldn't have bought it. Charlie would have been willing to buy it. So, fortunately, that we didn't get to the point where we had to make that decision that way. But he would have pushed forward when I probably would have faded. It's a good thing. It's a good thing that the guy came around. Actually, the seller was he's the grandson of Mrs. C, wasn't he, Charlie? He was Larry C's son. Am I correct? Or Larry C's brother. But he was not interested in the business, and he was more interested in girls and grapes, actually. And he almost changed his mind. Well, he did change his mind about selling. And I wasn't there, but Rick Guerin told me that Charlie went in and gave an hour talk on the merits of girls and grapes over having a candy company. This is true, folks. And the fellow sold to us. So I pulled Charlie out in emergencies like that.
We were very lucky that early the habit of buying horrible businesses because they were really cheap. It gave us a lot of experience trying to fix unfixable businesses as they headed downward toward doom. And that early experience was so horrible, fixing the unfixable, that we were very good at avoiding it thereafter. So I would argue that our early stupidity helped us.
Yeah. We learned we could not make a silk purse out of a sow's ear.
No, we learned.
So we went around looking for silk.
But you have to try it for a long time and fail and have your nose rubbed in it to really understand it.
Okay, Becky. Becky, quick.
This question comes from a shareholder named Mark Blackley in Tulsa, Oklahoma, who says, there has been more news than usual in some of Berkshire's core stock holdings, Wells Fargo and the incentive and new account scandal, American Express losing the Costco relationship and playing catch-up in the premium card space, United Airlines and customer service issues, Coca-Cola relationship and playing catch-up in the premium card space, United Airlines and customer service issues, Coca-Cola and slowing soda consumption. How much time is spent reviewing Berkshire stock holdings, and is it safe to assume if Berkshire continues to hold these stocks that the thesis remains intact?
Well, we spend a lot of time thinking. Those are very large holdings. If you add up American Express, Coca-Cola, and Wells Fargo, I mean, you're getting up, well into the high tens of billions of dollars, and those are businesses we like very much. They're different characteristics. In the case of, you mentioned United Airlines, we actually are the largest holder of all four of the large. We're the largest holder of the four largest airlines, and that is much more of an industry thought. But all businesses have problems, and some of them have some very big pluses. I personally, you mentioned American Express. If you read American Express's first quarter report and talk about their platinum card, the platinum card is doing very well. The gains around the world, I think there were 17% or something like that in billings in the UK, and 15% is the original currency, or the local currency, Japan, Mexico, and very good in the United States. There's competition in all these businesses. If we thought we did not buy American Express or Wells Fargo or United Airlines, but Coca-Cola with the idea that they would never have problems or never have competition, why we did buy them is we thought they had very, very strong hands, and we liked the financial policies in the case of many of them. We like their position. We bought a lot of businesses, and we do look to see where we think they have durable competitive advantage, and we recognize that if you've got a very good business, you're going to have plenty of competitors who are going to try and take it away from you, and then you make a judgment as to the ability of your particular company and product and management to ward off competitors. They won't go away, but we think, I'm not going to get into the specific names on it, but those companies generally are very well positioned. I've likened essentially, if you've got a wonderful business, even if it's a small one like See's Candy, you basically have an economic castle, and in capitalism, people are going to try and take away that castle from you. So you want a moat around it, protecting it in various ways that can protect it. And then you want a knight in the castle that's pretty darn good at warding off marauders. But they're going to be marauders, and they'll never go away. And if you look at, I think Coca-Cola was 1886, American Express was 51 or 52, starting out with an express business. Wells Fargo with, I don't know what year they were started. Incidentally, American Express was started by Wells and Fargo as well. So these companies had lots of challenges, and they'll have more challenges. And the companies we own have had challenges. Our insurance business has had challenges, but we started with National Indemnity as $8 million purchase in 1968, and fortunately, we've had people like Tony Nicely at Geico, and we've had G. Jane, who's added tens of billions of value, and we've got some smaller companies that you probably don't even know about, but really have done a terrific job for us.